Welcome to another edition of the NAIC Insight Series. I'm your host, Bob Green, and I am delighted to be joined today by Howard Sanders of Auldbrass Partners. Welcome, Howard.
Yeah, great to see you, Bob. Thanks for having me.
Absolutely. Been looking forward to this discussion for a while. Let's jump right in. So, Howard, tell us, introduce yourself and tell us about your firm.
Okay. Howard Sanders, founder and managing director at Auldbrass Partners. We're a secondary fund, not like most secondary funds most people hear about. We focus on verticals and we're growth oriented. So we try to make our investments in growth companies. We started 12 years ago. We have 15 people, 4 partners, and we've had very good performance to date. So very glad to be on with you and have the opportunity for a fund like ours to present.
Absolutely. Howard, a lot of the interviews I do are straightforward private equity, lower middle market buyout, venture capital. I would call them the more traditional and sort of known parts of the alternative investment industry. Give us the 5-minute version of secondaries 101. What are secondaries? How are they used? And why do you like that business?
Sure. Well, secondaries, to put it quickly, is providing liquidity to investors in low liquidity environments. The business really started after the tech bubble burst. A number of people were looking to sell their interest in venture funds, not so much venture companies. And a market was created out of buying venture funds. And also it became an alternative for managers that hadn't performed well. As we went into the financial crisis in 2008, we saw institutional investors were dramatically over allocated to private equity, and secondaries became a solution for that. That's where you started to see the multi-billion-dollar funds being raised in secondaries to allow large family offices, large sovereign wealth funds, endowments, pension funds to rebalance their portfolios and put them back in line with their strategic asset allocation. In more recent years, it's become a way for investors that are under target to private equity, real estate alternatives to get to target a lot quicker than they would have if they were doing just primary investments. So those portfolio management techniques have really come into play with the more sophisticated investors. And I think secondaries, has really gained more growth in assets under management than any other alternative in the last 5 years. We now have $20 billion funds being raised. And of course, when you get that type of activity, you have specialists that come into play. And that's what we are. We're a secondary specialist focused on growth.
Outstanding. So Howard, when you think about a deal, right? A big LP announces that they're going to, sell some of their holdings into the secondary market. What are you looking for in particular? And how do you evaluate the sort of drivers of getting a good deal?
Yeah, well, I started out at Citigroup as a co-head of the group that was responsible for complying with the Volcker Rule. Mm-hmm. After the financial crisis, all the banks had to sell their private equity and alternatives, and I was part of that effort at Citigroup. We had very large portfolios across alternatives, in total $5 billion. And a lot of the lessons that I learned there are still applicable today. We see $100, $250 million portfolios where an investor wants to achieve a certain price, let's say 92, 93 cents. In the opportunities where, for us, where the seller doesn't achieve that price, we can go in and strategically, what are called mosaic solutions, buy pieces of funds that are more appropriate for our fund size. Mm-hmm. With a $215 million fund size, we're generally buying $15 to $20 million portfolios or single LP interests. And we can be very selective and price to where a LP thinks they should trade. So when we see a failed deal, that's really an opportunity for us. I'm sure, The intermediaries don't like to call them failed deals. They call them mosaic solutions. But that's the start of when we see good opportunities. But that's just on the LP side. A new phenomenon has come into the marketplace where the GPs are actually utilizing the secondary market. And they're taking their trophy assets and spinning them out of the fund, which crystallizes their carry in the fund from that asset. It also allows new secondary investors to come in and replace their existing LPs in that specific company. So sometimes it'll be for a single company, a single asset solution. Sometimes there'll be 4 or 5 companies in a continuation vehicle. But that's really an innovation in the market that has led to GP-led secondaries and LP-led secondaries. And while we're pricing these portfolios of whether if it's a single LP interest we see or a portfolio over 100 million, as we're going through investment by investment, pricing the actual opportunity, we notice the companies that we think are most attractive, particularly in our verticals. And that becomes a place to start in a GP conversation about doing a continuation vehicle. If it's a middle market or growth fund, sometimes we can do it by ourselves. We can be part of a small syndicate. And in other cases, we'll join a very large syndicate.
So when you go in and you look at the portfolio, are you assigning a price based upon asset value to each portfolio company and then aggregating that to get the total price you're going to pay? Are you giving them value on some and they have to throw in the others? How does the trade work?
For our strategy, we really try to avoid unproductive assets. So unproductive assets are escrows, cash, those sorts of things where the best you can expect to get back is the amount that it's in the capital account statement for.
Yep.
But in general, there are really 2 factors. One is how long will your hold in that specific company be? If you're looking at a growth company right now, the holds tend to be longer because they're coming out of a trough. If a GP is expecting to go back to market and sell a company in the next 2 years, then of course that's going to play to your advantage in selling that company. So we try to get a sense of the timing of when exits will be, and then we try to get a sense of the underlying economics of the company. Are we buying it with a discount so that we're entering it a 7 times EBITDA, whereas the comparable companies, either public or transaction, trade at 9 times, right? And so that's our margin of safety. That's our cushion. And we'll price that in. We'll do a number of scenarios, a base case, a up case, a down case, and that's where the pricing falls out.
So do you like, and this is going to be oversimplified, but just as a general condition, are you excited when the markets are hot, or are you excited when we have a bear market and things look like they're turning down?
More so when things look like they're turning down, but there's an overreaction in the market. What we're most sensitive to is investors' perception of the upside in the market.
Gotcha.
So when the market turns down and there really are no fundamental issues, it's a very different story when you get an increase in interest rates like we've had. But even coming out of that, the typical institutional LP investor lagged their perception of the market. And we were able to buy when we were in a recovery. So that's really been the story of the last 6 months is we've been in a recovery for a number of different industries, and LPs are finally, willing to take the discount that it'll take to move a number of these assets. So when you're coming off of a hot market, it's very difficult to convince an LP to sell, at a significant discount.
That makes sense. So Howard, when I hear you talk about the types of trades you're doing, when I hear you talk about, tracking GPs as well as potentially their portfolio performance, it sounds like you've got a wide variety of skills that you need in your team. Talk a little bit about your team structure and what types of of resumes and bios you've had to bring onto the team to make sure that you can effectively do the job?
Sure. Well, our team tends to be experienced investors. Chris Sally, who you know, and I went to college with, we were roommates in college in the same fraternity. One of the most important things for a partner like that is that you have trust with them. And I have absolute confidence in Chris and really all of our team, but in his integrity to put the right numbers on the page, to make sure there's backup to all of those numbers, and we're not rushing into any specific transaction. We've also deployed a fair amount of technology in parsing through our pipeline, and we've automated all of that with a web-based, I guess you would call it an application, but it's a proprietary application that we've designed. And another partner of mine, Vish Apte, has been very active in the development of that and utilizing really all of the data science that's around tracking deals, tracking industries, tracking verticals. So those are my two primary investment partners. We're then supported by a team that is very experienced in using what we call Thesis. Thesis is our application. That's our system. And what's really required is an outreach type of sourcing where we're talking to LPs, talking to GPs, talking to intermediaries, and we don't wait for the phone to ring. So we have to have outgoing personalities. We have to have people who can build relationships on calls and be a welcomed call when they're calling multiple times. We have some good, hardworking, likable people in the firm, and that contributes to sourcing additional deal flow. Of course, we have very technically competent people as well, from the senior levels to the junior levels. But the most important thing is that we have really good people who are concerned about the impact of the companies that we're investing in. Not so much from an ESG perspective, but how are people really being impacted by this company? So we try to avoid things that they're not good for the environment, companies that are exploitative. Those are really not the areas for us. And the full team has confidence that we're going to invest in companies that are improving people's lives as opposed to detracting from them.
So part of the reason for my question, Howard, is there are multiple filters of engagement that you have to go through. So you start your conversation with an asset owner, right? You start your conversation with an LP, and you eventually, after your diligence and after the other work you do, you eventually transact. But once that happens, right, you kind of have your hands on the steering wheel, or at least your hands on the entrepreneur's shoulder, right? Because now you've got to take on the responsibility of driving the thesis, if you will. So I think you covered the piece on getting the secondary done, but talk to us now about what behaviors, what activities, what's it like once you actually buy the portfolio and now you're back in a mode of trying to drive growth.
Right. Well, as opposed to most private equity firms where there are two key players in the room, let's call it the entrepreneur or the CEO or the chairman of the company, and the private equity fund representative. That's a typical structure, and there's a negotiation going on between them as how to affect value most directly. We're the third leg in that meeting. We're a secondary fund that's come into either a company directly, or we don't usually hold board seats. We have 3 or 4 observer positions where we're really trying to navigate, helping management and helping the sponsor produce a outcome for the amount of time that's passed that is returning a 2 times 20% type of return for us. So I would say the most direct answer to that question is we try to do structurally what most people are doing hands-on every day. We try to, in our LPAs and in our governing documents, we're trying to create limits on leverage. We're trying to create limits on how long the investment will go on for, what the fee drag will be. And we establish that at the outset of a secondary deal and then let it ride from there. Most of our work happens up front, and then we monitor to make sure that those things are happening. It's very different than the hands-on type of involvement of a direct private equity firm.
Got it. Got it. So, okay. So now the obvious question for me, you had to learn to do this somewhere. You referenced Citibank.
Yeah.
Kind of take me through your background and how you got into this, because I've heard you describe it a number of times as the opportunity kind of chose you. So
Yeah.
go back and take me through how you got into the business and how you've prepared yourself to frankly be one of the leaders in the space.
Sure. Well, I'm from DC, as you know. Went to Gonzaga High School down in DC. And my father owned radio stations. He had one in DC, one in Baltimore, and one in Richmond. And he went from, in 2 years, from being general manager of the station to owning a fairly substantial piece of the stations. And observing him was really, those were the seeds for moving in this direction into private equity, into alternatives, into the investment space, particularly the private investment space. He was backed by a guy named David Gladstone at Allied Capital. And I recall I was fortunate enough for him to take me to the closing of the first station that he bought, WYCB in DC. And I found it funny that everybody was fussing about David Gladstone, a gentleman who was in the closing room, who I thought was a lawyer. And I wondered why they weren't paying attention to my dad. And my dad said, well, of course they're paying attention to him. He's the money. Mm-hmm. And I said, well, I thought you were the money. He was like, no, I'm the management. I'm the talent. There's actually money behind this deal from a third party. And that became an area of interest for me, just finding out more about this venture capital space. And back in those days, we're talking about early 80s. Mm-hmm. Venture capital meant investments in restaurants, radio, cable television. Everything was all venture capital. There really wasn't a differentiation between TMT and venture and global buyout. All of that came later. But I definitely had an interest in the space. And my dad went back to Mr. Gladstone and asked him, where's the right place for my son to go to pursue this industry? He wants to do what you do. Where would he go? And he said, well, my daughter is at the Wharton School, and that seems like the right place. Mm-hmm. So
pretty good advice.
Yeah, if you understood what he meant. So my dad came back and said to me, you should go to the Wharton School. So I went to the library and I looked in the college book. Back then you didn't have it online. It was just a book, and I didn't find Wharton College.
Right.
And then I came to figure out that it was actually part of the University of Pennsylvania. And I figured it would be pretty easy to get into University of Pennsylvania because it's a big state school, right? With the Nittany Lions, and I figured I'd be able to get in pretty easily.
Yeah, wrong end of the state.
Wrong end of the state. So then my dad told me it was an Ivy League school and that it would be pretty difficult to get in. But one of many incredible opportunities I've had just by being blessed. Just God has blessed me with these incredible opportunities without knowing how selective and how incredible it was to go to this school. I was admitted, went to the school. I did fairly well there, made some lifelong friends, and then moved into banking. I went to Chase Manhattan, went through credit training. And back in those days, every commercial banker wanted to be an investment banker. Mm-hmm. And every investment banker wanted to be a private equity investor.
Right.
So I started out at Chase, got a really good background in analyzing risk within private companies.
Mhm.
Went on to, again, incredibly fortunate to be admitted to Harvard Business School. And I found that the network was of all of the people I had worked with, as well as people I had gone to school with, they were incredibly entrepreneurial.
Mhm.
And they were all looking for a way to leverage their own personal talents. And so I felt that the best way to do that was for me to buy a business and to grow that into something sizable. So I bought a publishing business. After I left business school, I did investment banking for, I think, 4 years, and then bought a small business.
Mhm.
Uh, that's probably where I got the idea that you have to diversify your investments. You really have to spread your energy across a number of investments instead of a single investment. It was so hard to grow that single company. I mean, in 2 years, we grew it over 300%, but
Yep.
it was from a small base, and it wasn't that impactful when we really look back at it. So diversification became important to me. Limited downside became important to me. And as I moved back into Citigroup, CAI, City Alternative Investments, was just being formed. I had the opportunity to work with Michael Carpenter. He was the CEO of City Alternative Investments, and a number of incredible people who were at Citi at that time. And ultimately, ended up in the pension fund, investing the private assets of the pension fund. Everything, all private assets, all private funds, except hedge funds.
So with that background, Howard, you've got you've got early exposure to. You didn't call it this, but I'll sort of attach to what you've identified. You were basically describing the early days of the NAIC, right? I mean,
Exactly.
Gladstone wasn't an NAIC member, although they became one later, ironically. But I could lay some characters against the time frame you're talking about, early '80s, and that's Herb Wilkins, that's Reggie Lewis, that's Joanne Price, that's Larry,
Right.
Terry Jones. So the era that you're talking about resonates with me. But then you went on, you got a couple of Ivy League degrees, you got great training at Citibank. It should have been easy to build a firm, right?
Shoulda. Yeah.
That's not a
Should have been
recognition.
easy.
Should have been easy.
And let me just say, before we go into building the firm, when the history of private equity is written, there'll have to be a section on NAIC and Joanne Price and David Oxendine and all of the early Ed Duggar, UNC Ventures, and all of the early contributors. But there also has to be a significant section on Bob Green and just what you've done for the NAIC and how you up just the whole level of the NAIC. I mean, there was a time when, emerging manager was sort of a catch-all, and there really was no definition around who was in this group, who was in the NAIC group. And I think you've really done an incredible job of building out what our industry even is. Like, what are we talking about when we say NAIC? And people know now. So,
well,
thank you.
Thank you. I appreciate that.
Yeah, but I think then we had to go on to building a business after all these fancy schools and all this fancy background, and it was very difficult.
So before you jump into it, I wanna juxtapose these two. So tell me what you thought it was going to be like, right? Don't bleed into the reality. What did you think it was going to be like? You got the cocktail napkin, you got the airline tickets, you're going to go raise some money. What was your thought in your head? How long was it going to take? How much were you going to raise? What was the preliminary notion?
Well, we got a really good start.
Mm-hmm.
So if you go from where we started, where AXA Private Equity, now Ardian, backed us to spin out, as they had with a number of firms. There was nothing particularly special about our group other than we were at Citigroup, and Citi needed something to do with this once we sold all the assets that we had been managing.
Mm-hmm.
So Ardian came in, they backed us, they had us monitoring a portfolio, and they, as well as us, we thought there was an opportunity in smaller deal sizes, an ability to get deeper discounts. So if you would have asked me, I would have said, look, our separate account with Ardian is going to perform. We're going to do more and more and more deals, and then we're going to raise a big fund. I think we put on the cover of our first PPM, we put a $250 million number on the cover.
Mm-hmm.
That was the first fund and this was back when that was a significant amount of money. This was in 2011. And that $250 million number, in reality, can I talk about reality yet? Or?
Yeah, go ahead. Go ahead.
That ended up being $17 million.
Wow.
So it was really devastating to us that we raised, after 2 years of being in the market and having a couple of investors, mostly friends and family, and Morgan State University joined us in our first fund.
So I want to make sure everybody caught what you said, Howard. You had a plan and an aspiration to raise $250 million. There's no reason to think that was unrealistic. You had the experience, you'd managed that amount of money, or relatively close to it at Citi. And after 2 years of your best effort, you were only at 17 million.
That's right.
Yep.
But I have to correct you. I don't think that we had managed a similar amount of money, right? Okay. I had a very large portfolio at Citi, $13 billion pension fund portfolio. I was transacting on $3.5 billion, but I didn't have discretion over investments that were being made. So I lacked a track record.
Yeah.
And hopefully that's the message I'll get across today, is that you can do whatever you want to do as long as you have enough determination and you're blessed to be in a lucky enough position for things to go your way. I mean, that's really the lesson, because when institutional investors looked at our fund, they said, this is great, but secondaries are not ready for prime time. And you've never done it before. You've sold secondaries, you've bought secondaries in the context of a pension fund, but you have not managed a fund. So whereas others were spinouts from Landmark, and there have been Ardian spinouts, there have been all kinds of large secondary player spinouts. Newberry is a spinout from, I believe it's a Lexington spinout, if not a Landmark spinout. And so, that's usually the way the whole private equity industry reproduces, right? It has its young people go out and start new firms.
Fair, but let me challenge you a little bit on that.
Sure.
In that part of having the young people go out and start new firms, there's also this notion of, if I have a platform, I can go build anything I want, right?
That's right.
And I won't name any firms here because we're partners with many of them and I don't begrudge them. But there are a lot of firms that don't have a track record, and yet they're in a position because they're smart, they have a brand, they're well connected, and they simply want to do it. They get an opportunity to do it. I hope you agree with that, or you've observed that as well. Throughout this process, I've never observed you to be bitter about that, though, Howard. I've never observed you to be angry about it. What I constantly saw is you checking for the next door, right? You attempting to evolve, getting knocked down and getting back up stronger. So talk a little bit about what I'll call your resilience and the resilience needed to ultimately prevail.
Right. I've heard a number of people talk about that on this Industry Insights. Marty Nesbitt did a great job in several of the formats I've seen him in, talking about how likely it is that you'll get a no.
Yeah.
And when you knock on the door, you're going to get a no in most cases, but you still have to knock on the door. And then you have to go back and knock again after you've gotten the no.
That's right.
So, the resilience is really, it's really just a visioning of things can get better really quickly, right? Like as they did in secondaries. Secondaries went from a backwater that no one wanted to be a part of to a very important part of the market after the financial crisis. So in many ways, we were blessed with that. We were blessed with where secondaries went. We also had a very unique view of the market that you shouldn't buy everything. We were focused on earning carry. Call us old fashioned, but we wanted to make our money through earning carry, not through management fees.
And Howard, give us the fee structures that you all are typically participating in.
Yeah, so usually, a secondaries fund will be between 1 and 1.5% management fee and 10 and 15% carried interest. With the European structure, real estate style, whatever you want to call it. But we pay back all the money that we've, been advanced before we take carry. But it's definitely a lower fee structure than direct private equity. And the velocity on the money is a lot quicker. So we return capital. We really start returning capital almost immediately once we're invested. That's in a normal market. There's really no M&A in this market right now. So the distributions are a little slower, but they're much faster than direct private equity. Our average hold is 3.5 years. We would expect a direct private equity fund to have an average hold of 7 years. So, it's higher IRR, but that velocity of the money is a really important part of the story. So, but I think you're absolutely right that, there are other firms that are raising a lot of money very quickly. I think that the relationships we had built, Chris, Vish, myself, over the years, were really with GPs and operators. And, fundraising relationships are difficult to build from scratch. It takes a much longer time for someone who's not, pattern recognition is really the key to asset management. If you worked at a firm that people recognize, if I had worked at possibly Blackstone or Strategic Partners, one of the top secondary funds, I would have been noticed a lot quicker because the allocators would have known their reputation and I would have been able to feed off of that. But we didn't have that benefit. This was truly an entrepreneurial undertaking.
So we've talked around it a little bit, and you've been, pleasant and polite without really characterizing it. But there is an element of race. There's an element of diversity. There's an element of, obstacles in the market. Let's talk about the challenges of being a diverse manager. First, do you receive that title? I know the optics of my question, but do you consider yourself a diverse manager? Some don't.
Well, you've seen our website, so we are absolutely positively a diverse manager.
Good. I wanted to give you the opportunity to say that out of your mouth. So talk a little bit about your diversity.
Yeah. So we really at this point have all people of color. I mean, there are a lot of different types of people of color. We have Asians and Africans and African Americans and Caribbean and all types of people of color. And we didn't go out with a listing that said we were looking for that. Right. We just opportunistically hired these incredibly talented people and trained them in our way of doing things. So yeah, we are a diverse manager, but I'd love to comment on just the whole issue of, being Black, being, diverse manager.
I'm here for it. Yeah, go ahead.
And it feeds into the whole pattern recognition that I was speaking to.
Yep.
So, in most markets, small is good because you're aligned with the manager. If the manager's small, he really cares about the 1%, 2%, 5% that he's put into the fund. It's most of his net worth, and that's an important factor. But the response typically to, and I won't say diverse managers because there are some very large diverse managers, but managers who are entering the field, it's hard to build it from scratch. You don't have family relationships that support fundraising. You don't have professional relationships that support fundraising. So you're dependent on these institutions who say they want to invest with diverse managers. And those are usually public pension funds. And we have a couple of them that are invested with us, and they've been very supportive. So I don't want to group them into that. But in those programs, the main area of the public pension fund is looking for scale. They're looking for economies in managing their $100 billion. And the only option around, looking at smaller managers, let's call them emerging managers before we even get to diverse managers, the only option around that is to farm it out to a fund of funds. So we happen to sit in a particular space where it's very difficult to get noticed by fund of funds. We actually compete with fund of funds because they all have secondary businesses. So, being in that space between being, a direct private equity firm that can get an allocation from one of these diverse manager fund of funds and being a large secondary fund that's actually solving a problem like over allocation, it really just tells you that the path that we followed is challenging, right? And it's much better if you can do it to focus on investors who really need what you're selling, right? So there are small institutions that would benefit greatly from being invested with Auldbrass, and they're willing to hear the story. But the large funds are so loud that you tend to spend, as a small manager, you tend to spend a lot of your time on large pools of capital when you might be more appropriate for smaller pools of capital. So, and that all comes from this pattern recognition. The other thing is, as I was telling you earlier, we're a very values-oriented firm, from the investment side to the ethical side. We have our values and we stick to them. And that matters to a number of the foundations and endowments that we have invested with us a lot more than it does to, the $100 billion funds.
Right.
I would put Auldbrass up against anybody for our reputation, and we haven't embarrassed any of our investors. I can't say that about some of the larger funds, some of the larger private equity funds. So, and those same investors have embraced the diverse manager story. I think one of the challenges we as an industry have is that we didn't want to say diverse manager or BIPOC initially. And we said emerging manager to sort of soften the fact that we were talking about Blacks and Latinos and women, right? And because we did that, a number of other managers, especially the spin outs that I was talking about earlier that fit the pattern recognition better, they flooded under the title of emerging manager. So now we're fighting for our own space in the emerging manager space. And that was what it was, our presence there is what it was always intended to be.
Howard, what you're describing is a summary of what's happened in this industry over the last 25 years. And so much so, the transition has been so gradual and so smooth that a lot of managers, non-ethnically diverse managers, mostly white male comprised managers, don't have any sense that these initiatives, these pools of capital were formed to really help be inclusive and get more people in. But the moment, you remember the old sort of, formula for, what's a diverse manager. The moment we stuck carve outs and spin outs in there, and we said, you two qualify for these programs, we really did, the marketplace really did open the floodgate for a different type of firm. And if you're tracking with what I'm saying, I'd ask you the personal question. Do you think that that was intentional? And if it was, what do you think the goal was?
Yeah, I certainly do think it was intentional. You know, I think it's been an all out fight to preserve, you know, whether you're talking about what happened with the Fearless Fund and, you know, or what happened in front of the Supreme Court with affirmative action. And I think it's all certainly the opponents of affirmative action and the Fearless Fund see it as connected.
Yeah.
So I would have no choice but to say there must be some connection in whether if it's taking the emerging manager programs and sort of flipping them to a main focus on women firms, whether if it's taking the emerging manager programs and opening them up and changing the ownership from 51% requirement to 25%. You know, and in some ways, I mean, you have some really incredible firms like Fairview and Muller Monroe who really stuck to their guns and the mission. But I think there are others who've seen it as an opportunity to scale around the emerging managers. And it's a philosophical disagreement, right? It's a philosophical disagreement about what those programs should be, you know?
But you know, I guess if I sort of frame the point, when you hear the term affirmative action is such a loaded term, and we don't talk about affirmative action much in the actual industry and marketplace. But when you get into a court environment where laws and policies become reviewed, they are described as affirmative actions, right? But when you talk about a loaded and charged word like affirmative action and you apply it to diverse managers, affirmative action doesn't account in its algorithm for the fact that you've got 30 years of experience. It doesn't account for the fact that you went to and did well at the finest institutions in the country. It doesn't account for the fact that you've built a track record. And it doesn't account for the fact that you have, and you and your partners have, you know, worked for the deferred gain to capitalize your firm, right? None of those things get into the connotation of affirmative action. Yet the argument we have to have is affirmative action still necessary? So I don't want your interview to turn into a referendum on affirmative action. But you and I have had many glasses of wine and many conversations about this. Where do you think we're headed? Because I would offer to you that you still don't fit, and I don't fit, and our friends and partners don't fit the pattern recognition because they're not looking for us. So where are we headed, Howard?
Oh no, we're headed to the green fields, Bob. Green fields. So I think things are much better. I think things are much better. I mean, I've sat with Terry Jones, and you know, as he told me stories about Syncom, one of the hardest things they had to overcome was, you know, participating in a Series A and then having other investment firms with more capital come into the Series B, C, D, E. And there are just some remarkable companies like Clear that Syncom funded, and, you know, follow-on capital couldn't be raised for whatever reason. Now, I don't think that's the case anymore. I think, you know, the pattern recognition is coming, you know, whether if you're talking about Vistria, Vista, Carrick, these are incredible investors, 645. There are a number in each asset class that, you know, really take away the ability for someone to dismiss a diverse firm because it's diverse. So the pattern recognition is there. Hopefully we'll create a way in secondaries, you know, for a firm coming behind us not to be dismissed. But I really do think it's getting a lot better. There's a lot of opportunities out there. And look, it's hard. It's got to be hard, right? Because there's such a huge payoff in being in private equity. And that's why the barriers to get in are very high. That's why there's a lot of shade being thrown, behind the scenes. I think most managers will do anything for an allocation. So saying something about another manager is not out of the question. But I think things are getting much better. Where I see it going is firms like ICV, firms like you name it, Vista, or you name it.
Clear Lake.
Clear Lake, yeah, for sure. And I'm reluctant to, because once I start naming the firms, I'll have to name more firms. Right. But they'll in time they'll have their own spin-outs.
Yeah.
Right. And so I think that the general view is that it is possible to have a top performing diverse manager, because it's been done so many times now. Yep. There's 15, 20 firms that you can name who are at the top of their asset class who have performed better, and your research really shows that. So I think that has to open the way.
So Howard, I appreciate and love to hear your optimism. When you're in the room fundraising and you're talking to an LP, are the facts more advanced than they were 5-7 years ago? Right? Are the things that you're saying generally accepted by
they are now?
Talk about that.
I think before the NAIC started having its conferences, before you started putting out research reports, actually talking about where diverse managers fall. I think when you start having major consulting firms spending resources on diverse managers like Cambridge and Jasmine Richards, that is a sign that there's a recognition that there's unrecognized performance in this space that can be unearthed. It's discoverable, as opposed to the great problem with private equity is that when you find a good team, by the time you're ready to invest with them, they've already raised too much money. Right. That's and so maintaining alignment with a manager who's raised a lot of money is very difficult. Whether if it's KKR, Blackstone, it doesn't really matter who it is. It's very difficult to have alignment. So I would say, yeah, that's definitely a given now, is that there is performance in diverse managers that may not be widely recognized, and that manager may not have raised too much money yet.
So that's great to hear. We've got 10 more minutes, and I want to make sure I squeeze in several topics. I want to give you a chance, and this may get to be a little too personal, but share with us what you can. What's the future of Auldbrass? What do you think about in terms of either linear funds, ancillary products? Where is your thinking and your partner's thinking on what the future could hold? We're not going to hold you to it, but what could the future hold for Auldbrass?
Yeah, the future of Auldbrass is definitely in what I call private equity derivatives. Okay. Right. And private equity derivatives may extend to infrastructure. It might extend to data centers. There are a number of areas where we have a competitive advantage. I am reluctant to go too deep into it. But the market also seems to be in a new position for investing in GPs at a smaller level, right? So GP stakes is a business that's now on the horizon for managers that have 500, 750 million in AUMs. And those are discussions that are on the frontier for Auldbrass. But we want to do more.
Where's the line, Howard, in that conversation with smaller GPs? I'm sorry to interrupt, but I need you to.
No, go ahead.
Where's the line between staking and GP stakes? Because it could look very similar with a different objective.
It could.
Yeah,
for sure. Staking, though, is I don't think you have much of a chance unless you create a really compelling economic opportunity for the capital.
Yeah.
If you can make a lot of money for the capital that's coming in, there are going to be more GP stakes funds out there. I think staking, and tell me if this is what you're referring to, when a large public pension fund decides to stake a manager,
Mm-hmm.
It can be quite limiting when they attempt to do that through the documents.
That's right.
And they try to create alignment through the documents as opposed to really being aligned with you, so that there is an individual who is negotiating with you who will make more money personally.
Mm-hmm.
When it's the big pension fund, it's much more difficult to create that alignment through documents, and there'll be turnover in the future. Right. So I think you're in a much better place with an individual who you know and you trust, and you can structure something that'll work to the benefit of both of you. But I'm very pleased with the number of I'll call them GP stakes funds that are actively looking at diverse managers right now. Yeah. It seems to be one of the best times for a diverse manager to scale.
I heard someone recently describe, well, actually it was David Rubenstein, describe the private equity industry as one of the oldest industries in the world, but still rapidly evolving, right? And if you think about things that we're talking about now, 20 years ago, we were not talking about secondaries, right? 10 years ago, we were not talking about staking. 5 years ago, we were not necessarily talking about seeding, right? Co-investment has been an increased conversation over the last 10 to 12 years. There's just a lot that continues to be discovered, and this industry that we have called private equity continues to yield innovation. What are you hearing, thinking, and seeing relative to innovation in the space?
That's interesting. That's an interesting question. The innovation, I think, is coming from more sophisticated entrepreneurs, right? So the whole concept of a private equity derivative, which is someone who sits between either the LP and the GP, or possibly between the company and the GP or the LP. Yep. So I think innovation is coming from some really sophisticated CEOs and CFOs on how to use the private credit markets, how to use leverage and where to get that from, how to use mezzanine financing. That's an old term, but not equity, not debt, and how to use it. And a number of either fund of funds or endowments or pension funds going directly to the source to make investments. I think the innovation and the structure will come more than likely from the CEOs, CFOs of the companies, as opposed to intermediaries or investors coming up with structures.
Got it. So I want to shift gears in the last 5 minutes that we had. About a month ago, you and I ran into each other in Boston in a classroom on Harvard Business School's campus. Yeah. And it was great to see you there. But I noticed that you were one of the more senior alums in the room. Yeah. And you shared with me that you've been going to the Naylor Fitzhugh conference for 30 plus years. What do you when you talk to young people, right?
Yeah, that's why I go. That's why I go.
So I want you to sort of give the pre-piece, but when you talk to young people and you give advice on how they should think about and approach their careers, what do you say to them, Howard?
Yeah, my first statement to them is, it takes time to learn your craft.
Yep.
Focus on your craft. Make sure you know what you're doing, and you don't just have a surface, knowledge of what you're supposed to be an expert in. So it's develop that expertise. Really know what you're talking about. I mean, really know. Every extra second should be spent on developing new knowledge around your craft. Yeah. Well, maybe not every second, but most of your time should be spent in your early years developing an expertise in your craft. And that's just the model that I come from. You know, I come from Wall Street, so there was a remarkable amount of time required to be a junior person on Wall Street in the 80s.
Yeah.
And I think, you know, if that can be replicated today, it will really serve young people well. That's what I tell them. And then we get into the particulars of how you strategically deploy that knowledge.
So take us into that a little bit.
Yeah, well, you know, whether you were to go to business school or not go to business school doesn't change the fundamental package.
Right.
You know, and young people really need to understand that. The biggest determinant of your success is you right now in this moment. That is the biggest determinant of your success. And if you sacrifice that to whether you go to business school or not, whether you change jobs or not, you know, the best opportunity is right in front of you where you are right now. And if I think what a number of people, especially with the Great Resignation and the pandemic, what a number of younger people are missing is just the benefit of experience.
Yeah.
And being strategic around which experiences you want, but you have to trade, you know, depth for breadth. And it could be a good trade, but that's really what I'm talking about. You know, everyone has a toolkit, right? And so you might start out in marketing and you'll move to finance, and then, you know, you'll move to strategy, but each one of those experiences goes in your toolkit and will make you a better, you choose the word, investor, manager, strategist, you know, in the future. So.
Well, Howard, we've come to the end of our time. You've been very generous in terms of sharing both your time and your wisdom. And that's no surprise. You've always been generous in that way to me. I want to tell you, I have been a huge fan of you and Chris in terms of how you built the firm. I've seen you be resilient, and I've seen you have triumph as well. And I continue to wish both of you the very best and look forward to all the good things that the future holds for you.
Okay. Well, thank you, Bob. Thanks for giving us the opportunity to be a part of this. And thank you for mentioning Chris, of course, Chris, Vish, Steve. The whole team here is very appreciative of you giving us this platform and allowing us to be next to these great investors who've been on this industry insight. So thank you.
Awesome. Take care, Howard.
Okay. Bye-bye.
Bye.